Hi everyone, this is Accounting Made Simple with Akim. Remember the last video we did on consolidated financial statement IFRS 10? I spoke about elimination of intercompany transactions that we need to start looking at that because in consolidation you need to ensure as much as possible that you eliminate all intragroup transactions because if you don't do that you'll be double counting the figures in the consolidated financial statement. So in this video we'll be talking about debtors and creditor transactions. Also we're talking about when there are sales and purchases of goods between the holding company and the subsidiary, either from the holding company to the subsidiary or from the subsidiary to the holding company, and also as it affects when there's what we call goods in transit between these entities. So let me just start by a simple explanation of what debtor and creditor transaction look like. This is when there are outstanding balances between the two entities at the end of reporting. It might be as a result of loans issued by the holding company to the subsidiary, or as a result of past sales and purchases between these entities before the consolidation. So there's a lot of things that can happen. We can have variety of transaction between the entities and resulting in some outstanding balances. So at consolidation, it's expected that these balances are written off against each other. So let me use this example. I try to make one example down. Let me insert some rules down so that we can give a solution to the example that we have above. So in the example, we talked about Company A issues an interest-free loan of $1 million to its subsidiary Company B during the year. Company A holds 70% of the shares of the Company B. How will this transaction be treated at consolidation? So, what we only need to do, first of all, we need to understand what has been posted when this interest-free loan was issued to Company B. So, we need to first of all post that transaction and see how it look like, then we can know where to write it off at consolidation. Okay, so let me start. When company A issues in the books of, let's say, books of company A. So when the company issues a loan, it debits um, loan receivables and credit, say bank, for instance, because the loan has been given out $1 million. Yes. This is debit. This is credit. Okay, let me just do something here so that we can put the dollar sign here. Let it be in the middle so that it will look light, nice, and sharp. Um, so this might have been what have been posted in books of company A. So let's look at books of company B, books of company B. So let's insert more. I think we should insert as much as possible. Yes. So books of company B, then we will have debited bank. The money will have come to the bank account of company B, while company B will have credited loan payable account. So at consolidation, we'll be having this balance of loan receivable and also the balance of loan payable, which doesn't make sense. So what we need to do is to write off. And if you look at the bank here, we don't need to do anything to bank because look at it here. We have credit bank because when you're consolidating, you have. Okay, let me just do a a simple balance sheet, a pro forma balance sheet. So bank account to look like we are debiting bank, we are crediting bank. So at the end of the day, bank is the movement in the bank is still zero. So we don't need to do anything to bank. But loan receivable, that's the asset side. Loan payable will look like something like this, which doesn't make sense. Loan receivable, because we have debited loan receivable, we need to just put it here. The loan payable. So our pro forma statement will now look like this. So it doesn't make sense having so it's still zero. So it doesn't make sense having loan payable and loan receivable, because somebody will ask you what's the component of this loan receivable. When you say that, oh, this loan is receivable from my subsidiary of company B, it doesn't make sense. So at consolidation, there's need to write it up. So what do we need to do? Now correcting journal at consolidation. Sorry. So correcting journal at consolidation, because in the books of A, which is company A, loan receivable has been debited. So what we need to do is we credit the loan receivable, credit loan receivable account with $1 million, and you debit loan payable. So with that, those transactions will nail off in the books. This is really, really, really most simplest of what you can get in intercompany elimination. So, but let's go further by start looking at, okay, what are those transactions that could have caused uh, intercompany entries between these entities. So one of it is that we talked about earlier is sales and purchase between the holding company and the subsidiary. So this is when there are sales of goods or purchase of goods between the holding company and the subsidiary. And this type of transaction, it is expected that we have what we call unrealized profit. I'll tell you why. Because when an entity sells goods and services or goods to another entity, it is expected that the entity will realize profit as a result of the sale, because you can't just sell at your cost price. So you need to sell at value above your cost price, which is a profit that you generate on sale. So when company A, who now owns 70% of the shares in company B, now sold to company B and realize certain amount of profit, that profit is called unrealized, because at consolidation it can be a profit in the books of A on a standalone basis. But when you are doing consolidation, you cannot realize profit from yourself, because company A now becomes the holding company, becomes one entity. So when you now say you realize profit from yourself, doesn't make any sense. That's why we call it unrealized profit. So let's look at this example down. Let's look at what the question says. The question says Company A owed 70% in the shares of Company B. Company A sold goods to Company B worth $15,000 with a margin, don't forget the word margin, and 20% of these goods remained unsold by Company B as at the reporting date. How will these transactions be eliminated on consolidation? So um let's look at where the unrealized profit might be coming from. Let's try to post what transactions Company A and Company B will have posted in their books. So Company A, for instance, which is the most important part that we need to look at, is solution books of Company A. So in the books of Company A will have said, okay, I'm selling these goods to you. Let's assume the goods are sold on credit. Let's assume it's sold on credit. So when Company A sells, it too debits receivables account because it's sold on credit, right? What's the value? 15,000. But when he's selling it, it's not 15,000. Don't let's make a mistake. When he's selling at a margin of 15%. So the cost price. Let me just do a simple calculation here. Cost price is 15,000, but there's a margin on sales, margin of 15%. 15% times this. So I'll give it some space. Yeah, you have this plus this. So on this, the goods worth 15,000, but there's a margin. Oh no, not 15%. Sorry, 25%. I made a mistake. 25%. So the total sales value is 18,750. So that's what will be the receivables value. But Company A will have credited sales with two elements. So I will need to why I will need to separate this. I will need to separate the cost price and the margin. I will tell you why I'm doing that later when we get there. Because just take this and put it here. This is debit. This is credit. Yeah. So let me separate the cost and but it's good to put it together, but let me just separate it. Profit, credit, profit. So because I want to show that profit separately, so that when we are going down the line, you'll be able to understand why we are posting some transactions. So this is the books of Company A. And also don't forget that, let me tell you one funny thing. When Company A bought the item, it was bought at 15,000. It means that there's also element of um, there's a movement in the inventory. So the inventory that company A has will have reduced by certain amount, which is the 15,000. So that inventory in and out is both 15,000, and that's why we are not so much concerned about the inventory of Company A. But let's go to Company B, books of Company B. Of Company B. So in Company B books, when Company B buys the item, when Company B buys the item, it will debit inventory purchase for how much? Is no more 15,000, is those two items, 15,000 and 18,750, and credits payable account because the items were not paid for yet. So this is what Company B has done. So now the question now says that 25%, no, 20% of these goods remained unsold as at the reporting date. So when 25%, 20% of this remain unsold, it means that this profit that we have is still sitting in the books. That we need to understand that that profit that company A made or company B made, certain percentage of the profit is still sitting in the group at consolidation, and this needs to be eliminated. So let's now look at the entry that we need to pass. Okay, so at consolidation now, so what do we need to now debit and credit? Because the question says that 20% of the goods remain unsold as at the date of consolidation. So what we need to look at is at consolidation. Um, we debit it was profit and loss. I'll tell you why we're debiting profit and loss. Why we're debiting profit and loss is because that profit of 3,750 has been in the books of company A while it's selling to company B. So that profit we said is unrealized profit, so we need to debit that element. But I don't want to say exactly how much we're debiting now, but just to know which account to debit and which account do we credit is inventory account. That inventory account will be the inventory account in company B because company B still has some element of the inventory that it has yet to sell to a third party, which is 20%. So um, let's look at it this way. Um, we say that 20% remain unsold. 20%. That's 20% of the total purchases um, from company A. But that's 20%. But what we're saying is not all the 20% we're talking about. We're talking about the margin on the 20%. What is the margin on the 20%? The question pointed it out for us here and says that the margin on this amount that was sold to company B is 25%. So we now take 25% of the 20% which is remained also. So times 25%. So that is 937.8. So let's say that 938. So that amount is what we call unrealized profit that we debit to profit and loss accounts and credit to inventory. So let's look at the third situation that we have here, which is goods in transit. The goods in transit here can arise where the entities are located different locations apart. Say the items or goods are being transported over the sea. Be as at reporting date, the items have not been received by company B at consolidation. So what we need to do is just to look at let's look at the same example that we used above. Let's assume the item has not been received. So the first thing we need to do is to receive the item at consolidation, because if you don't receive the item at consolidation, it will still be showing at consolidation that company A is expecting some receivable from company B, and that element of unrealized profit will still be there. So the first thing is uh, we debit let me say solution. You're using the same example up, but that the item has not been received. So you debit inventory just like what we did earlier on, and we credit payable accounts. But yeah, so what are we doing? The same amount is as simple as this. It's very very simple. Just once you understand that concept, then we won't have any problem. So then unrealized profits on sale. Um, unrealized profit on sale, the same thing, debit, profit and loss. Let me just copy from here and credit, debit the same amount. So for the purpose of our discussion here, we won't be going deep into um, element of unrealized profits to the extent that company B now sell the item at maybe a certain price above that purchase price from company B. So that's another explanation entirely. For the purpose of that, of this consolidation, we'll be limiting it to this place. And I want you to watch out for my next video, which I'll be talking about impairment of assets or impairment of goodwill on consolidation. And also, I'll also be talking about sale and purchase of subsidiary. Sometimes when you sell or purchase a subsidiary, you can either gain control or lose control while selling. So those things will be discussed in my next video. Watch out for them. Thank you.